Welcome back to the Talking Hedge. I'm Josh Kincaid, Capital Markets Analyst and host of your Cannabis Business Podcast. Today we've got Keith Black. He has 30 years of financial market experience, serving approximately half that time as an academic and half as a trader and consultant to institutional investors. He currently serves as a Managing Director of Content Strategy for CAIA, which is the Chartered Alternative Investment Analysts Association. During his most recent role at Enos Knupp and Associates, Keith advised foundations, endowments, and pension funds on their asset allocation and management selection strategies in hedge funds, commodities, and managed futures. Dr. Black earned a BA from Whittier College, an MBA from Carnegie Mellon University, and a Ph.D. from the Illinois Institute of Technology. He's earned the Chartered Financial Analyst, or CFA, designation and was a member of the inaugural class of both CAIA and FDP members. Keith, thanks for being on the podcast.
Thanks, Josh. Thanks for having me. And so I work on writing the textbooks for CAIA. I work on grading the exams for CAIA. I'm co-author and one of the voiceover artists for the fundamentals program, and then one of the first members of the FDP Institute as well.
So the markets have been doing some crazy things, some unprecedented events, like talking about negative interest rates potentially after the Fed's reduced rates to zero, and then talking about potentially hitting negative interest rates for oil. Kind of unprecedented. Have we seen anything else like that in the markets right now?
So Europe has had negative interest rates for over a year. There's $15 trillion of negative yielding paper in the world. It started with the sovereigns in Europe, and now that's spread to even non-investment grade or junk bond companies in Europe. Some of them have negative yields, and so what we see is that the dollar continues to be a very strong currency. And so when we know that the dollar is a strong currency, the dollar has positive interest rates, and you have negative interest rates in Europe, that could bring a lot of capital into the U.S. coming for those positive interest rates. And so if you're a German-based investor, you have negative interest rates on German bonds. You come over to the U.S., you buy treasuries at 1 or 2% yields, and you have a positive return on the dollar. There's a significant positive return for you as that investor. And so what we'll see is that as the dollar continues to be strong or even stable, if interest rates in the U.S. are higher than those abroad, we'll continue to have capital flowing into the U.S. It's a very interesting time, as you said, for the commodity markets. We're going back many years of oil prices, and so we're making almost 10-year lows in oil prices in the last few weeks. But you've heard that the U.S. government wants to refill the Strategic Petroleum Reserve. The state of Texas is encouraging producers to shut in supply. So we could see a near-term floor here in the oil price. But that assumes that we get back to some level of normal economic activity in the U.S. So hopefully these lockdowns last maybe 1 to 3 months. We get on the backside of the disease as China has already done. China is already ramping up their production. So they got hit in December and January, and now at the end of March they're starting to come out of their lockdown. So if we can do that in June or July and get back to normal, then maybe there's some upside to oil. But we need the trucks to run, the cars to go, and certainly the airplanes to fly to see some upside in the oil sector.
So there's nothing normal about this. I think the last time that Texas decided to reduce output, I wasn't even born. I think it was 1976. And then, you look at the dollar, which is increasing in value, or another way to say that is every other foreign currency is decreasing in value as they chase they want to close out their positions. My understanding is that some of these dollar denominated loans need to close out. In order to do that, you have to borrow US dollars, which is creating an artificial shortage or basically a short of dollars. And that's driving up the US dollar decreasing. Like I think we saw Australia decreasing 8% in one day on their currency. Have we seen anything like this where there's been a dollar shortage as people race to close out dollar denominated loans?
Well, we call this a flight to quality, and there's a perception that the dollar and U.S. Treasuries are going to be strong in the face of a crisis. So part of this is panic buying, simply because people want to be in what they perceive to be a relatively safe asset. And so if that continues, the dollar and the Treasury market will continue to be relatively strong. If you want to go back, I think it's 1998 and 1994. There's some interesting history from Asia. You could look at a currency crisis in Thailand, Malaysia, and the Philippines, where they had fixed rate currencies relative to the dollar, and so the corporations in Southeast Asia were borrowing in dollars, but they had revenues in Malaysian ringgits and Thai baht. And so what happened was the local government couldn't support that fixed rate currency anymore. So the government was buying the local currency and selling dollars. And the point came where the governments ran out of money to support that trade, and we saw a downside in those currencies in just a few weeks of 30 to 60% as they broke off that fixed rate. And so what happens now is those companies that either had to source goods abroad or, as you said, had dollar denominated debt, now their liabilities are 30 to 50% higher than they were just a few weeks ago. And so if you have dollar denominated liabilities, you don't want to have all of your revenue in a local currency and all of your liabilities in the dollar. Initially, you thought that it was cheaper to borrow in the U.S. or there was more money available in dollars than in your local currency, but you have to hedge what we call an asset liability mismatch.
Speaking of hedge, where do you see the alternative investments right now? It seems like a systemic risk. Margin calls are liquidating pretty much everything in a portfolio. It doesn't seem like anything is sacred and that everything is plummeting. Is there an alternative to invest in the meantime when margin calls are still being met?
So on the publicly traded side, there is a lot of downside risk. You see U.S. stocks down 20 to 30%. The real estate sector and REITs are down 40%. And we're starting to see downside in both investment grade and in high yield debt. There's some places you could buy supposedly investment grade U.S. debt yielding over 7% today. And so there's an assumption that a lot of that debt that's currently rated investment grade isn't going to have a good credit experience going forward.
I was going to ask you to explain the significance of that, because with some of the REITs or the real estate investment trusts, if they get downgraded, won't that affect a lot more companies? Because if you're a pension plan, you have to have a certain, whether it's AAA or otherwise, you have requirements in there. And if you're downgraded, then they're forced to sell, and that sort of exacerbates the situation. Some of the multi-state operators in the hemp and cannabis industry, being like MedMen, one of the most popular, will they be affected if prices of commercial real estate drop just like a percentage or two? You're saying some of these stocks are down 40%, but as a whole, if the industry sees a correction, there should be, New York is already seeing some vacancies like they've never seen before. So where is the risk with the commercial real estate and in the market right now?
So I'm working from home right now, and our full company is. And so the concern is, what if people like working from home?
Hmm.
What if the company actually perceives that productivity is equal or even greater working from home than working in the office? If that's the case, even if we're locked in just for a few weeks, that might change the long-term behavior of companies if people like working virtually. Uh, we're also worried about stores and restaurants. If we're out for just 1 or 2 months, could we lose a substantial portion of the stores and the restaurants? Right, they need to pay their rent in addition to their salaries when they have little to no revenue. Certainly, the cannabis space a lot better than I do. But maybe that's a flight to quality where people who are able to pay their rent and work at home need a little anxiety reduction, and maybe that's something that that is going to remain strong. But we saw probably an 80% downside risk in the publicly traded cannabis space in just the last few weeks, even though we're bouncing off those lows the last couple of days. And so for commercial real estate, whether it's multifamily, whether it's office, whether it's retail, industrial, it all comes down to, are people paying their rent? And there's a knock-on effect here, right? So not only does the restaurant or the store go out of business and not pay the rent there, the people who used to work there have to pay the rent on their apartment building, and so that's another area of that commercial real estate where we might be seeing some downside risk.
I think after 2009, when we hit the lows on March 9th of 2009, a lot of those people who lost their jobs in construction or wherever it was at found occupations in as waiters and waitresses. And so as everyone is being forced to shut down, that's going to maybe shift them to the grocery stores in the meantime to collect a paycheck. But it's going to have a dramatic effect on the industry as a whole. There were people who left Microsoft to start food trucks, and that's really just kind of expanded the amount of restaurants. And in my opinion, I'm not a foodie, but I go to a lot of places and I'm just not satisfied with the value that I'm getting. So the food isn't as good as what I'm supposed to be paying. Go to a nice Thai restaurant or Indian restaurant, you're supposed to pay $100 for me and my wife, and that's not even including alcohol. So whether the forced consolidation or capitulation occurs, those people are going to have to find another job. Is there any idea of where they may land? Is there any data to support some theses on where the new occupation will flow?
Right now, Amazon is hiring. And so you've got unprecedented demand in supermarkets as well as any kind of delivery, right? And so whether you work for UPS or FedEx or Amazon, Amazon's looking to hire 100,000 people to deliver packages, and I'm sure a lot of them are on furlough from hotels or restaurants or retail operations that are now furloughed.
Mm-hmm. This seems like it's more of a symptom, where the problem, in my opinion, or from my experience, seems like it could be a Forex play. And I'm wondering about your opinion on my hypothesis here, where China was devaluing their currency, and that forced a lot of Chinese to take that money and bring it to Vancouver, San Francisco, Seattle, Toronto, and they put it in piggy banks in the form of housing. So in the spring and summer of 2016, half of all Seattle suburbs were having real estate being purchased with cash, which is pretty unheard of, 60+%. And so that flight to safety, as you mentioned, in my opinion or my view, seemed to be more of a Forex play to get the money out of China so that the prices wouldn't be depressed. And now that we're kind of seeing close to support levels or the bottoming out eventually, do you think that, or do you see the housing being sold as a result, and then housing prices also taking a fall similar to 2008?
So there's two things that drive the housing market. One is the local job market, and two are these international money flows. And so at the end of the day, you have to look at Hong Kong and San Francisco as generally unaffordable to people unless they have these great jobs in tech or in real estate or in financial markets. But I'm really worried about this, working at home trend, right? Why should someone be in a crowded, expensive city like San Francisco when they can move elsewhere? And we're seeing tremendous job growth in Austin and Nashville and Columbus and some of these other places where you could buy a house for less than a quarter of the price that you can in Northern California. And so if this work at home trend really accelerates, it's going to be hard to support the prices in some of these cities.
Kind of want to get into the market a little bit with some investment opportunities. The cannabis and hemp space, as you mentioned earlier, has taken a beating, just about the same as every other sector. I think Hilton was down 33% on Tuesday or Wednesday this week, which is really hard to lose a 30-year market cap in a single day. And the cannabis industry has been no different. So today is an up day. I think that's a dead cat bounce. I think we're still going to see some margin calls, but overall, the industry has taken such a beating that I think eventually we're going to see the bottom. Hexo has a 42% increase today, but what is that with a 22-cent gain? That's really nothing. But machine learning and everything else is going to I think, have an impact. We have an AI-based cannabis index. And so our competitors, being MJ and Podex, are down 64 and 67% since August 1st, whereas our AI-based algorithm that has technical analysis with predictive analytics is up 37%. I'm working with a portfolio manager who's also a CAIA member, Rohit Srivastava. He's with Saroj and Banu Fund. I met him at the Seattle chapter of the Chartered Alternative Investment Analysts group, where I was a panelist for alternative investing. This is back in August. And so by comparison, year to date, almost 4% doesn't sound that good until you look at the competitors that are down almost 45 and almost 60%. Where is the future with alternative or with AI and machine learning?
Given what we've seen in alternative data, people are building long-short equity hedge funds, and I assume the reason that your fund had positive returns is either you took short positions or you got completely out of the market when you saw a downside signal. And so what we're looking for in hedge funds is generally a hedge fund can be both long and short stocks. So a mutual fund is generally 85 to 100% long. We gave you the money to invest, and you're investing it for better or worse. But when you're in a hedge fund, you could be 100% long, 100% short, and a lot of these equity long short funds are on average 50% net long. So the long-term position might be 100% long and 50% short. Ideally, you've got good stock picking on both sides, and you're going to take half the risk relative to the market. So hedge funds that are doing their job shouldn't have a 30% drawdown in this market, because they should have had some kind of short positions. What we see is that managed futures or trend following funds actually have positive returns in March and year to date, because what trend following funds or black box managed futures funds are trying to do is, as you said, the technical analysis. And so basically what most of the funds are doing now is they would be long the dollar against some basket of foreign currencies. They'd probably be long treasuries, and they would be short commodities and short equities at this point. And so in March, we're actually seeing positive returns from a lot of those trend followers and managed futures funds.
So is that the same as MOMO or momentum stocks?
So momentum is part of managed futures. And so in managed futures and trend following, basically, if there's an upside trend, you want to be long. And if there's a downside trend, you want to be short. And so you're using technical analysis to determine where those trends are. And so right now, obviously you'd probably be short all of the risk assets and long the flight to quality assets like treasuries of the dollar.
How do you guys use VIX? I remember in 2008, fourth quarter, and then first quarter 2009, looking at Hartford Investment Group, HIG specifically, they were predictable looking day to day. If there was a dead cat bounce, you could short it and almost guarantee that that's the direction it was going to go. And then the next day, you could close that position and then go long on the trade. Are you using volatility as an instrument to gauge, the next day's response?
What VIX is a measure of the price of options traded on the S&P 500. So we're looking at every put and call option in the front two futures months to come up with a price of volatility. And over the long term, VIX trades at about 20%, which is our long-term estimate of equity volatility. But recently, VIX has been trading from 60 to 80%. And so when we look at assets that are likely to have positive returns in a down market, over the long run, we see that managed futures and macro hedge funds do have those positive return in down markets. Anything that has investment grade debt or treasuries probably has a positive return. And then if you're careful with equity derivatives or VIX or tail hedge funds, those could also have positive returns. And so if you had the foresight to buy put options on the S&P 500 or any equity index, or if you have long positions in VIX, those are both very positive this month. But the problem is the long-term return to VIX funds is actually negative because it does have this ability to make money in down markets. Everybody likes to own VIX, and so it's going to have a cost of carry, and so it could cost you 2 to 4% per month to be long VIX in a market that's relatively quiet. And so even though you made 5 to 10 times your money on VIX products in March, if you hold them till the end of the year, you could actually lose money on that because people pay to be in VIX.
Mm-hmm. What does your crystal ball say about finding the bottom? I'm looking at Tesla right now because I've bet somebody in California an ounce of California's finest that Tesla will hit $2. Now I made that bet when they were at 900, so literally at the peak is around Valentine's Day is when I made this bet. Do you think that we're going to see Tesla hit $200? And what's your crystal ball say about the market overall?
Well, we're really worried about car sales, right? And so in China, car sales were down probably 80% in the first quarter, and I think the Chinese factory of Tesla was closed for a while in the first quarter, and now I guess in California, California is on lockdown, and the Tesla factory is not an essential business. And so we really worry about people's cash flow and whether they're able to build cars and whether they're able to buy cars. And so it depends on how long we're all locked in and what our ability is to buy a car after that. I think the good news for Tesla is that when it was $800 to $900, I think they were able to accomplish a secondary offering. So they got a lot of cash from selling stock toward those highs, which shores up their balance sheet. And so the key to something like Tesla is to follow the bonds. So you need to look at how much money Tesla has borrowed, what the maturity structure of that is, and what the yields are. And so the question is Tesla worth? I see on your screen there $84 billion of equity market cap, or are the bonds non-investment grade and trading below par? And so in some of these situations, the bond market is the smart money. And so if they can't pay their debt, then it's hard to justify an $80 billion market cap.
Mm-hmm. When I made the bet, I thought that Boeing would be the catalyst. This is before Corona became a full-on pandemic. I knew that the 737 MAX was, I think, 1/5 of the GDP for the U.S. And looking back at 2008, we saw airlines and automotive industry just completely get annihilated. And with all of the underlying distributors and manufacturers, I just assumed that would be kind of the catalyst to pop this bubble that we've had for a while, from real estate to commodities. And so with Boeing recently asking for a bailout, I find it fascinating that all of these companies, from banks to airlines, everyone was buying stock back at the highest, most expensive market we've had ever. And then now they're not doing stock buybacks. Wouldn't now be the most opportune time for stock buybacks? Why were they buying it then, and why aren't they buying it now?
Yeah, so I guess the airline industry spent over 90% of their cumulative cash flow buying back stock. And so right now is the time to have cash, right? And it doesn't matter what you did with your cash in the past. You want to have cash now. And so, to the extent that you bought back stock in the past, you probably paid way too much for that stock. Politically, the buybacks are now linked to the bailouts, and so I would anticipate any bailout, whether it's from the airlines or Boeing or automakers. I think any bailout is either going to have the government, buying stock at current levels, or prohibiting buybacks in the future. But the government actually made money on the bailouts in 2008, which is really interesting. A lot of people don't realize this, that whether it was TARP or TALF, when they bailed out the large banks, when they bailed out some insurance companies. Now, and Fannie and Freddie, the government actually made money on those, because we didn't just give them money; we actually made investments in their companies, and when they recovered, those investments became more lucrative for the government. And so the net cost of these bailouts in 2008 was actually a net positive investment on these cases. And so if the government has strings on these rather than giveaways, if they're actually investments, we would potentially profit in the long run once we get back to a somewhat normal and mobile life.
That adds fire to the conspiracy of Reagan's working group. They call that the plunge protection team. And that's the conspiracy that at 12:45, the last 15 minutes of trading, the plunge protection team steps in and buys up all of the stock to make it rounded, like right at zero, so that there is no loss. But out in the open, they've been discussing buying equities in exchange for the troubled asset relief program. So instead of just giving companies bailout money, they're buying their stock as a form of support or relief. And then, like you said, they made money in 2008. Not really something that they normally do. Like AIG, they kind of just let them fail. Boeing, they may end up doing the same thing because there's a lot of public pushback. What's that going to do to pension plans, though?
So right now, if you were invested in both stocks and in bonds this year, you are at a loss for this year. And so on the equity side, we're trading back at 2017 levels. And so if you just own the same basket of stocks you owned in 2017, you're down on that. But there's a nice gain in the bond market that somewhat offsets that. And so there are probably losses in the pension asset portfolio, but we also have to look at the pension liability portfolio. And so we're looking at the number of pensioners and what their wages are. relative to interest rates. And so here, zero interest rates are a huge negative for the pension community because we're discounting those future liabilities at a lower and lower interest rate. And so as interest rates go lower and lower, the liabilities of the pension plan increase. But we also need to anticipate how many pensioners we have and how long they're going to live. And so at this point, we need to anticipate mortality experience for those pension plans. The longer people live, the greater the pension liability, and the shorter people live, the lower the potential pension liability. So there's actually three pieces. It's the asset portfolio, it's the number of pensioners and how long they take benefits, as well as the interest rate experience. So there's a lot of moving parts.
And how does a market, including pensions, get affected if negative rates go into effect?
So a lot of pensions have an assumed return of 7%. And so when we put stocks together with bonds, together with alternative investments, we need to have a 7% long-term return. So we've got the employees making a contribution, we've got the employer making a contribution, a 7% return. And if we have all the contributions and a 7% long-term return, we're able to pay benefits. If that long-term return from our portfolio does not reach that 7% level, either the taxpayers, the employers, the employees have to put in more money to offset that lack of investment gains, or in the long run, people are going to take lower benefits from those pensions.
So if we hit negative 14% GDP, you're telling me that Illinois is pretty well screwed.
I moved out of Illinois about 10 years ago, and we're seeing a big outflow from these high tax states, whether it's New York, Connecticut, Illinois. You're having a lot of people leave that state because of the tax burden and the fiscal situation. I actually know people whose job is to recruit hedge fund managers to move from New York and Connecticut down to Florida. And it's a pretty easy sell right about now, both tax-wise and weather-wise.
Yeah, that's not going to help these state and government employees that have pension plans, though. So regardless of where you're moving to, if those individuals are expecting a pension payment, sounds like they're going to have it sounds like those payments are going to be cut significantly.
Well, you've got corporate pensions and you've got public pensions, and so corporate pensions are going to need to be backed by the company. And so if the company doesn't get their 7% return, then either the company has to put in more money or cut their benefits. And so in the private sector, we've seen a huge move from defined benefit to defined contribution. Mm-hmm. So now the company's not taking the investment risk; they're putting that investment risk onto their employees. But so now the largest employers of defined benefit plans are now state government workers. So the police, the fire, the teachers are the ones who still have these defined benefit pensions. And again, if they don't get that 7% return, either we have to raise taxes to pay it, or eventually pay less in benefits.
Well, before we wrap this one up, I want to talk about the upcoming exam for the CFA, or the Chartered Financial Analyst designation. They hold those every June and October, I believe. And it's one of the most difficult designations to get. I think it has maybe a 20% success rate. And so is that still going to happen? Because I know that you have them in a room. How are you going to do this exam, given that you're supposed to have social distancing?
Right. So I'm a CFA charter holder, but I work for CAIA, right? So I don't speak on behalf of CFA. Mm-hmm. CFA has had all three levels of exams in June historically, and then level one was also offered in December. And historically, these have been all live exams. And so I took my CFA level 3 exam in McCormick Place in Chicago, with probably 2,000 other people in the same room, and you could put those desks 6 feet apart. And so CFA announced this week that that they're moving their June exam into December for all three levels, and so that gives people an extra 6 months to study. And given that it's March now, people weren't fully completed with their study program for the June exam yet. And as I said earlier, hopefully this is all behind us in May or June, and we could come out of hiding and reduce that mortality. And so hopefully by December, life will get back to normal. But CFA does have difficult exams, maybe a 40% pass rate at each level. And as you said, less than a quarter of the people make it through all three levels.
Yeah, that's pretty wild. And so are you expecting a decrease for CAIA or the Chartered Alternative Investment Analysts Association? Are you expecting those numbers to kind of decrease as people take a step back and try to figure out what's going on with the world, or is it just business as usual?
So we see that to some extent, education is countercyclical. So when people don't have a job or when people are worried about their job, they actually want to have more credentials. If people aren't traveling, if people are locked in, they actually have more time to study. And so in March, we were hoping for one of our largest classes ever, and some of that will be deferred into our September window.
Mm. Yeah, it's not easy. A friend of mine was sitting for the CFA level 1, and the guy next to him was crying. Just a full-grown man just sitting there sobbing that the exam was too hard. So I don't know if he didn't study hard enough, but maybe this is a blessing in disguise where people have more time working from home. They're looking at a career change or other opportunities. They might be looking at CAIA as one of those tools to help them either keep a job or get promoted or otherwise.
Right. So at CAIA, we have a level 1 and a level 2 exam, normally in March and September, but we haven't been able to test as many as we'd like in this March window. We have about 200 hours of study per level with about a 60% pass rate. And CFA is about 300 hours of study per level with about a 40% pass rate on each exam. So it's about half of the time commitment for CAIA, as you'd see with CFA.
Yeah, that sounds almost reasonable. I know that the CFA was literally, you kind of just had to say, nope, this exam is the equivalent of having a baby. You're just dedicated, focused, and you have to literally ditch everything and everyone for 90 to 120 days and just isolate yourself prior to self-isolation. But yeah, I enjoy that the FDP, CFA, CAIA, CAIA, all of those seem like amazing opportunities, and maybe people will start to take a look at that now that they've got some more time working from home.
So what we found is that people are graduating from university, even an MBA in finance or a master's in finance, and they go to work for a pension fund, and they say, "What classes did you have in hedge funds or private equity?" And they say, "My university doesn't even offer those courses." And so since 2003, universities have largely been behind the curve. And so people are coming out of even an MBA or a master's in finance without the skills to go to work for a pension fund, a sovereign wealth fund, or a university endowment that has large investments in these areas. We also have a 20-hour video-based course called The Fundamentals of Alternative Investments. This is a quick online program, open book, meant for 100% pass rate to get people up to speed. So we're seeing, college seniors. They have a finance major, but they don't have dedicated courses in their program in alternatives. They would take this before they would go out on the job market to have a good sense of what's going on in the world of alternative investments. So we started the CAIA program in 2003. 11,000 people finished that. The Fundamentals program started in 2014. 6,000 people have finished that. And just last year, we started FDP Institute, Financial Data Professional. And so this is a one exam program focused on the uses of data in the financial markets. So we look at big data, artificial intelligence, machine learning, robo-advisors, alternative data, and then we require some coursework in R or Python to go with that. And so what we see is that hedge funds are starting to use what we call alternative data. So traditional data is everything coming out of the stock market. So an income statement, a balance sheet, price and volume from the stocks. But alternative data is kind of interesting. And so hedge funds are reading your email. Hedge funds are looking at your credit cards. And so if we look at everyone's email and everyone's credit cards, we could try to find a revenue forecast for a mail order company or for Amazon. And when the companies report their earnings, you said, "Oh, I already knew that," right? Because I read enough of your email and your receipts to figure out what your revenue is. You could look at satellites or drones. So satellites and drones can tell you, how much oil is in a storage facility, how heavy a ship is, how many people are parked in front of what stores in the mall. And so those are all kind of big data, alternative data sources. And then you've got social media. So some hedge funds are reading everyone's tweet on Twitter, if you could imagine that. So we're downloading everything on Twitter, and we're sorting it by stocks. And so we could try to figure out what the sentiment is on Tesla today. And so we read every tweet on Tesla. We use natural language processing, and we figure out whether people are talking, positive or negative about Tesla today. Or we could even look at cell phone signals and geolocation data, so we could figure out how many cell phones are turned on in the Tesla plant to see, how they're ramping up production and how many people are working in the factory. And so that's our newest designation. It's a really exciting area that the people are getting up to speed on.
That's pretty interesting. So basically, we used to say bad data in, bad data out. And so you've basically created a financial data professional to give a designation to somebody trying to aggregate all of that data and make sense of it. It's interesting using AI and all of that technology and social media. People with their apps are giving you all kinds of access. But what we found, at least in the hemp and cannabis industry, is that you can take and aggregate information, but without a professional to utilize a spreadsheet and make it useful, people aren't really able to do a whole lot with it unless you have a professional. And so what are some of the results you're seeing as a result of launching this new designation? Are you coming up with new reports, new access, or what are some of the success that you've seen as a result of this financial data professional?
So the first people who are taking this, are financial professionals. Maybe they have the CFA charter, FRM or CAIA. And so they're equity analysts, or maybe they're interviewing managers who are employing these tools. And I took the program myself in the first class. And what was interesting to me is the programming is not the hard part. That people have built these amazing libraries in R and Python, that it's relatively straightforward to program these. But as you said, it's the data that's the challenge, right? And so, what data do I want to use? What story do I want the data to tell me? And what business problem am I trying to solve? And so it's not the programming that's the barrier. It's an understanding of what goes into the program and an understanding of what comes out of the program and how am I going to use that in my business solutions.
If people are interested, Keith, how can they get a hold of you if they've got some information or questions? And how can they take a look more about CAIA and what they have to offer?
So our website is CAIA.org or FDPinstitute.org. You could contact me through there or on LinkedIn, and questions could go to candidate@CAIA.org, and they'll help you sign up for the exams.
And all of those links will be in the show notes. So with that, we're going to roll this one up. I want to thank my guest, Keith Black. He's a Ph.D., he's a CFA, CAIA member, and FDP member. Keith, thanks for being on the podcast.
Thanks, Josh.
I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.